A little known technical indicator is flashing red. The last time it crashed, stocks went right down with it. Is the tech bubble about to burst? Stay tuned, because right now we're facing a summer slowdown that could lead to a massive correction. And historically, this would not be a shock, because right now investors, they're still enjoying the summer. But right now things are changing in the U.S. economy. We're seeing companies miss earnings expectations. We're seeing demand further slow down. We're seeing money dry up. And what that means is we could be facing a major stock correction. Tech mega caps drove rally's last leg, built on narrow market breadth. And this is a key thing to understand, because when you see a concentrated rally in a small number of stocks, it's a huge warning sign for where stocks are about to head. The NASDAQ has beaten the Russell 2000 by more than 15 percentage points over the past 200 trading days. And again, this is another warning sign. You want to see small caps rallying here, because they are a sign of the real U.S. economy. And still, that lead isn't as big as the previous episodes of tech outperformance, and it suggests that momentum around AI may not be powerful enough to lift benchmarks on its own this time, because the risk, and this is a big one that we've been flagging, is will all of this AI spend lead to more profits? Again, going in forward in the coming quarters, we're going to find out if they can make money on AI. If they can't, watch out, the bubble's about to burst. And we're seeing a lot of signs that there is a bubble in stocks. Right now, the risk is the highest since the bursting of the dot-com bubble. And after the brief spring reprieve following the April Liberation Day, we saw an aggressive sell-off across all sectors. Signs of froth excess have emerged. And one of the reasons we're seeing this is because every dip is being bought. And that's a challenge, because there's really no reason for it. Investors just see stocks drop and they're buying back in. Again, that's exactly how you get to bubbles. Because right now, TMT valuations are the highest they've ever been, and concentration risk, especially excluding mega caps, is now greater than any point since the dot-com bubble peaked in 2000. Of course, we all remember what happened after that. Let's take a look at this next chart, because you can see the concentration within the S&P 500 has surged to the highest level in decades. See, right now around 33%. Go back to the dot-com bubble, you can see what happened. Earnings started to go down and stock prices went with it. Right now, earnings are a laggard, and that is not a good sign for the health of the market. And this is one reason the esteemed strategist Michael Hartnett of Bank of America is warning, and big. In his latest report, he notes at the tail of the tape, this is the Mag 7, Avgo, Oracle, and Palantir, 80% of the S&P 500 returns since Liberation Day. What he's saying is there could be an AI cash burn threatening AI overbuild trade. Now keep in mind, he said this is the same story as back in the second half going into the dot-com bubble. Everybody was spending big on being a dot-com and not realizing how to make money doing that. The market came crashing down right after that, and next thing you know, we had a recession, and that was a true spark for productivity. And what was the productivity gains we got? Fewer employees. That means those who did keep their job had more work. We saw productivity rise. Inflation came right down with it. But that's not the only risk. And we're going to look more at breadth here in a moment, but there's also vol risk. Let's turn to Nomura, who notes this week that it would take a sustained multi-selling lower in spot equity price, holding higher vol to generate a destabilizing systematic de-risking of recent positions. Now, what are they trying to say there? If stocks were to go down and continue to fall and volatility was remaining elevated, it would signal a systematic machine positioning drop. I'm going to show you those trend lines, what to watch out for. But in other words, we now spot lows, new downside grab to really get the mechanical de-risking flows going. And if that happens, it opens up markets to greater downside risk. And that's what we're facing here. Markets that are overvalued. Going into what is historically a summer slowdown, we're seeing breadth start to fall off. And again, this is the major risk to the markets right now. Investors can't see this in a price chart. We'll look at that in a moment. Let's take a look at the breadth of the S&P 500. And right now, what that means is 56.85% of the S&P is trading above its 50-day moving average. Now, remember, when we talk about moving averages, if you're below a major moving average, like the 50 or 200-day, it's a bearish signal. In the short term, it's the 50-day we care about. The problem is everybody's focused on the Mag 7. They can't see what else is going on here. And you can see very clearly that breadth is still on a decline and price is rallying. Now, if this price point was supposed to be valid, you'd see breadth a whole lot higher, and we are not seeing it. Now, if you're trying to trade these markets and you want a game-changing strategy, we've got it. It's called our Metre strategy, and what it does is it combines 9 professional trading strategies into a single intelligent signal generator, providing 31 times more frequent buy signals. Now, it does things through multi-strategy consensus. For trend following, we've got the Bravo 9, the Turtle Train, a 200-day moving cross, golden cross, and trend pullback. On momentum reversal, we've got the RSI divergence and a 520 EMA cross. And for breakout and support, we've got channel trading, Fibonacci retracement. But here's the thing, we target a hold period of 2 to 15 days. Optimized for swing trading, we've got 155 signals per year and a success rate of 55%, and that blows things away. But it's going to get better. We're going to optimize this thing, working on that right now. Grab those links in the description below. Sign up for either program. It's now included at no additional charge. Be sure to use the coupon codes to grab your free 30-day trial. Now let's turn to the S&P 500. We noted the breadth was on the way down, but look at the other technicals. You don't see it in the RSI. It's at 63. You see it in the MACD, but that thing jumps all over the place. In fact, our own Momentum Timer Pro, who actually looks at those technical indicators and the trend, flagged 3 consecutive daily buy signals. But how about machine positioning? Well, we modeled that in our CTA Timer Pro. We see on our short-term algorithm there was a pullback here. What that means is there could be some machine buying. I'm going to show you the machine positioning here in a little bit from Goldman, and so you'll understand that the machines can be buyers here. But let's take a look at the price chart of S&P 500, because what do you see? No red flags here. You see a little dip, it got bought, and now what are we facing? A breakout of the recent opening high. But when we take a look at the NASDAQ, well, the risk is we're seeing potential bubbles here. Let's take a look at breadth, because only 50% of the NASDAQ is trading over its 50-day moving average. But all people care about is the top 7. You can see price is breaking out, and breadth is saying, look, we're not going along with it. And again, these are the major issues. If we see more companies fall along the wayside and only a few companies drive price, you're going to see a reversal. This happens every time. This is one technical indicator that few people even look at, and it's the one that is the most accurate. Let's take a look at the Invesco QQQ Trust here. What do we see? RSI is at 66. Again, no warning signs. MACD negative cross, no big deal. But how about our own Momentum Timer Pro? You've got 3 consecutive daily buy signals. Again, machine positioning coming back up. We'll watch the S&P follow likely to the upside here. And again, momentum's been bouncing around, but the trend is turning higher. Let's take a look at the chart, because once again, you do not see this, what's going on with breadth happening here. You see price, new all-time high, and investors excited that this is going to go up even more. But again, the risk is it's what they can't see. Let's take a look at machine positioning here. We've got this from Goldman. They note their short-term level 61.89. Now, our own CTA Timer Pro, we pull data from a lot of different sources, but what makes us unique is we run a historical overlay. So we know when the machines are likely to be buyers and sellers. That's how we make a difference trading machine positioning. Let's take a look over the next week. Uptape sellers at 5 billion, 2.5 billion into the US. But look at this. If stocks were to go down, this is that mechanical de-risking that Nomura was talking about. In a downturn, you could see 234 billion of global equity sold, 76 billion in the US. And that would be dangerous, because look at global CTA positioning. What is it telling you? They're maxed out. So if you're looking to go long foreign equities, if you're looking for machines to give you any boost, you're not going to see it. Now on the US side, we get a slightly different picture here. What do we know? Machine positioning fairly long, but not maxed out. And that's what Goldman is saying here is, look, if price goes up, we could see some more movement by the machines, but the risk is starting to skew to the downside. Let's take a look at the Russell 2000 here. What do we see? Only 47% of it trading above its 50-day moving average. Again, price went up, breadth jumped, and then it rolled over. Price is held, but again, it's another big red flag. Every time we see breadth move to the downside, what does it tell us? Stocks are likely to follow. Let's take a look at the technicals, because the RSI is cooling off at 51. MACD's got a negative cross. Momentum Timer Pro 8 consecutive daily, that should be sell signals here, not buy signals, and we see machine positioning backed off a little bit. So if you're looking at this and saying, where's the opportunity in the market? Well, hang tight. We've got some options for you here, but let's take a look at the Russell 2000, because of the 3 charts, this is the one that tells us there's some problems. Now let's zoom out to the 1-year chart, and what do you see? Price is running right up against that red line. Now, if you don't know what that is, that's called the volume profile. That's where the most shares have been traded over the last year. Buyers tend to be below, sellers above, and right now you see price rallied up, didn't get to these 2 purple lines. And what are those 2 purple lines, my friends? It's called the supply zone. What happens? Price goes up, it's the supply zone. That's where the sellers are at. They're above. Buyers are below. They didn't even get there and kind of ran out of breath, so to speak. The risk now is small caps roll over and head down. That does mean that we could see a further rally in the mega caps. The problem is here, it won't be sustained. Now, will energy continue to sell off, or is what's coming soon going to lead to a big rally? Let's take a look at what's happening in the news here, because Zelensky rejects ceding land as European leaders back Ukraine. Meanwhile, Trump is scheduled to meet Putin in Alaska. And this is the issue here. Everyone thinks something's going to happen, and you can see that in the price charts. But if it doesn't, look for there to be a short-term rally in energy here. Let's take a look, because momentum is clearly negative. The RSI has been dropping. It's down to 44. If it gets below 40, that's where the warning signs start to show up. MACD's got a negative cross. The trend's been down for 7 consecutive days, right alongside momentum. Machines are building a short position, or at least they should be, on our fast algorithm. And again, you see momentum continuing to drop here. Again, those from our own reports, Momentum Timer Pro and CTA Timer Pro. Links in the description below, and be sure to use that coupon code for your free 30-day trial. Now let's zoom into the 6-month chart here. What do we see? Price is below that 6-month volume profile. That is a red flag, but it's right at the bottom of that trading range here. Upside is it right around the 200-day moving average. You can see clear signs of overhead resistance. Now, depending on the outcome of that, we could see prices rally up, but I would look to be a seller up at this zone. That's where I think if you see a price rally here, where the exit point is. Again, we don't know what the outcome of this, but the market suggests something's going to happen. I'm wondering if we're going to see something completely different. Now, the markets were very bullish on banking stocks. I said, don't touch these things. Sure enough, I had that one right. Let's take a look as momentum's negative. The RSI is cooling off alongside the MACD. Momentum Timer Pro, 7 consecutive daily sell signals. We see machine positioning sold off a little bit. It's buying back as price holds. But let's take a look at those charts, and then we're going to get us some trades that I think are going to put some money into your pocket. Let's take a look, because we saw financial stocks dip right down into supply zone. Now, remember what we just said about supply zone. Buyers are below. So what are you seeing here is buyers are stepping in on this zone. The problem is they're not getting much of a push. You see, they've been buying, but price is just, well, going nowhere. The risk is you got that 6-month volume profile below. If it drops to that and breaks there, that's a bearish indicator. Then you're looking at the 100 or 200-day moving average in blue and orange, respectively, there as your next downside target. But let's take a look at emerging markets here, because this was Wall Street's darling, and I said, well, maybe not, but we have a position on it. So let's take a look here. How about Momentum Timer Pro? 3 consecutive daily buy signals. RSI is at 60. MACD's got a negative cross. But how about our meta strategy? Now remember, this is a consensus strategy. It picked up a buy signal. Now it is down slightly. You can see from the 7th, down 0.32%. This is a live stop loss level. Yes, my friends, we give our subscribers risk control levels. We do think there's some opportunity here. How much, I couldn't really tell you. But when you're playing chase all the way at the top, remember, you got to keep your stop losses tight. Again, it pulled back. It's rallied up here. Again, our point where we bought in was back on the 7. So we got a little bit. If price rallies here, of course, we'll look to raise our stop loss accordingly. Let's take a look, because I think the bond market could be where it's at. Now, we do know that Michael Hartnett of Bank of America has been flagging this for recent weeks here as the opportunity. And we said, well, hold off. We're not there yet. But something I want you to keep in mind, we're going to likely see rate cuts in September by the Fed. So that is, again, bond bullish, so is machine positioning. CTA shorts in US dollar remain stretched versus longs in other currencies. With a move lower in US dollar this week, stop loss triggers are not too close in the near term. Now, what does that mean, not too close in the near term? It means you're not likely to see the machines cover those short positions. Now, I do have some short positions in the euro, and that would be dollar bullish if these machines would cut to those stops. We're not there yet, but we'll take a look at the chart, and I think we're coming close. Now we see Bank of America notes that CTA is looking to be buyers at 10 and 30-year Treasury futures. Well, let's take a further look here. How about momentum? Well, on TLT, this is a long bond. Momentum's positive. The RSI is at 53. MACD's got a positive cross. We've got 6 consecutive daily buy signals. You might remember we bought into this last week. The price rallied. We raised our stop loss levels, and then we got stopped out for no gain. And that was from our meta strategy, but sometimes no gain's okay because you still have your cash to turn around and reposition. I think there's going to be an opportunity here, and let me show you. Because while they note that the machines are going to buy, we have modeled they should be buying here. Momentum indeed turned around. But let's take a look at the chart of TLT because I think there's going to be some opportunity here. Now you have a bottom. Price rallied, made a little higher low here, and then what happened? It pulled back and made a lower high, and then it rallied again and made a even higher low. From there, I'm looking for it to pull back into this volume profile line. If it does that, I'm looking to be a buyer there in a big way, particularly going into that next Fed meeting. So I think there's opportunity in the long bond. Now, something interesting that happened over this weekend was in gold. You remember on Friday, everybody said, look, you got to go out and buy physical. There was a bunch of YouTubers that came out and said, look, you have to run down to Costco and buy gold. I laughed because hours later, they changed their headlines and no, you should sell gold. Well, of course, nobody did either of those things. But it's hilarious because the White House is going to clarify gold tariffs after ruling sparked chaos. Well, it did on YouTube for that matter. How about gold shares here? We see RSI is at 57. MACD's got a positive cross. 5 consecutive daily buy signals. And back on the 5th, well, our meta strategy tipped us off. That trade now up 0.86%. We got the stop loss levels at 310.37 right at our opening price. Why did we do that? Because when price rallies, we raise our stop losses. Something else we made money on. Remember, we got stopped out of this and we're back. How about gold miners? This one went out on the 5th to our CTA Timer Pro subscribers. There's a typo. There was not a meta strategy trade. It was a machine positioning trade. That up a whopping 6.32%. Again, I have these programs not just for me to make money, but for you to make money right alongside. That's why we do this every day. We give you the trades. We give you risk control levels. We want you to make money. Now, where do we think GDX is likely going? Well, it's probably going to see a hard reversal here. Let's take a look because on the news it shot up. That's why we're raising our stop loss level. We expect there to be a pullback on Monday, but even if there is, we're likely to put some money in our pocket on that trade, and that is all that matters. When you're swinging, you got to make money, raise your stops, and bank your gains when you can. Let's take a look at UUP here. That is the dollar bullish ETF. Momentum is positive. RSI is at 51. MACD is negative cross, but MACD isn't always on this. Now, we did get stopped out of our meta strategy trade for a 0.69% loss, but let's take a look at the charts here because I think things are going to be changing for the dollar in the near-term future. This is one of those reasons I held on to my euro shorts because I still think the bullish case for the dollar is there. You see it rallied up here, pulled back right into that 6-month volume profile. Now, it's a little below it, so it's kind of bearish, but what's underneath? A flattening 50-day moving average. That's a good sign here. If we can see some things change and the dollar hold the 6-month volume profile range and then find some buying support, you're looking at squeezing those CTA shorts, and from there you're looking at a potential rally up to its 200-day moving average. Now I want to zoom out here and show you there's not a lot of volume here. If it could break out over 28.40, that would be at the 200-day, and then from there you're looking at potential move up to 29.25. Now keep in mind, watch the breadth, because if breadth continues to decline, it's a very bearish signal for the markets, could cause a major correction here. Remember, you heard it here first. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.